So far in 2022, investors have had to deal with a lot of market uncertainty. There are a lot of risks on the market right now, such as inflation, rising interest rates, and the possibility of a recession. During times of uncertainty, investors may want to own companies with stable cash flows and solid business fundamentals. That's where the best companies to own list from Morningstar comes in. The 126 companies on this list all have big advantages over their competitors, and we think those advantages are stable or getting bigger. We think that the best companies have predictable cash flows and are run by teams of managers who have a track record of making good decisions about how to use capital. But the best companies don't always have the best stocks at any given time. It's also important how much an investor pays to own a company, best or not. So here we'll talk about the 10 best companies whose stock prices are the most undervalued right now. These are the 10 best stocks. However, before we start our countdown, we would appreciate it if you would subscribe to our YouTube channel and also press the bell icon. Let's get started. 1. Masco MAS. This year, the stock of the world's largest contract chip maker has been hard hit by macroeconomic uncertainty and a slow outlook for smartphones. But we think that these headwinds have given stock investors an attractive entry point. Taiwan Semiconductor stock trades 46% below our fair value estimate of $166. Morningstar analyst Felix Lee says that the demand for high-performance computing will be the biggest growth driver over the next 5 years. He also says that industrial and automotive demand will remain strong, even though the consumer outlook isn't very good. 2. Yum Cha. Of coronavirus cases has put pressure on the Chinese restaurant industry. We think the biggest restaurant chain in China, Yum China, is being unfairly punished. Yum China stock is 44% undervalued compared to our estimate of what it should be worth, which is $86. Ivan Su, a senior analyst at Morningstar, says there's reason to be optimistic about restaurants like Yum China, whose brands include KFC, Pizza Hut, and Taco Bell, because they have the size to be aggressive with prices in the near future, give customers more access to their food through strong digital ordering, delivery, and drive-through options, and have healthy balance sheets. 3. Anheuser-Busch InBev. Anheuser-Busch InBev is a large brewery with a large global scale and a high regional density. The company has a history of buying brands with promising growth platforms and then expanding distribution while ruthlessly cutting costs. This helps the company get an exemplary Morningstar capital allocation rating. Philip Gorham, director of Morningstar, says that AB InBev has one of the best cost advantages in our consumer defensive coverage and is one of the most efficient operators. We think the market has been undervaluing AB InBev stock for a long time. The stock trades for 41% less than what we think it should be worth, which is $90. 4. Salesforce. This year, the technology sector as a whole has taken a beating, and so has Salesforce stock. Even though the enterprise cloud computing solutions provider is likely to have a drop in revenue growth below 20% at some point in the next few years, we think that ongoing margin expansion will lead to compound earnings growth of more than 20% for a much longer time. Dan Romanoff, a senior analyst at Morningstar, says that Salesforce has built a front office empire that it can build on for years to come. We think the company will continue to make money through cross-selling and upselling, price changes, international growth, and more acquisitions. Romanoff says, "We think Salesforce is one of the best long-term growth stories in software. Compared to our fair value estimate of $305, the price of Salesforce stock is 38% too low." 5. Comcast. Growth in Comcast's cable business has slowed, and we expect it to continue to slow as more customers access fiber and wireless network alternatives. The drop in Comcast stock suggests that the company will lose a lot of customers over the next few years. However, Morningstar director Mike Hodel says that this is not likely to happen. Comcast stock trades about 36% below our fair value estimate of $60 today. The second quarter was a mix of good and bad, and no new broadband customers were added. We think investors should instead focus on how well the company can generate strong cash flow and keep a strong balance sheet even though there are still problems. 6. Zimmer Biomet Holdings. Zimmer Biomet is the leader in large joint reconstruction, and we expect demand for large joint replacement to be strong, says Morningstar senior analyst Debbie Wang. This is because of good demographics, such as aging baby boomers and rising obesity. The company has cultivated close relationships with orthopedic surgeons and therefore enjoys vendor loyalty, which has helped the company dig a wide Morningstar economic moat rating. Zimmer plans to accelerate growth through innovative products and improved execution, adds Wang. The stock trades for 35% less than what we think it's worth, which is $175. 7. Software from Guidewire. Guidewire stock is undervalued by about 35% because it was sold off along with other tech stocks in 2022. Property and casualty insurers can get software solutions from Guidewire. Romanoff, a senior analyst at Morningstar, says that the modern software platform of Guidewire has shaken up a quiet industry that had been poorly served by legacy software vendors. Since the industry can no longer wait or pay to keep old systems running, he says, we see a long runway for more growth. So, we've given Guidewire a positive Morningstar Moat Trend rating. 8. Equifax. Equifax, one of the most important credit bureaus in the United States, is having a hard time right now because the mortgage market is weak, which has led to a drop in mortgage credit inquiries. Still, we think the market is being too harsh. Equifax stock trades 34% below our estimate of what it should be worth, which is $320. In fact, Morningstar analyst Rajiv Bhatia says that we think Equifax's workforce solutions segment is different and growing at a healthy rate. We also think that the segment's fundamentals are strong. It is now the largest part of Equifax. 9. TransUnion. The price of TransUnion stock is 32% below what we think it should be worth, which is $115. TransUnion, one of the most important credit bureaus in the US, had a bad second quarter, so the company lowered its sales goal for the rest of 2022. Still, TransUnion's data is very important to its customers' underwriting decisions, and it is hard to get into the business. Analyst Bhatia from Morningstar says that both of these things help the company's wide economic moat. 10. Masco. We think that Masco stock is worth 30% less than it should be. Masco makes a wide range of products for home improvement and building. Over the past few years, the company has changed its management team and business model. Morningstar Sector Director Brian Bernard says that the company's management has cut costs and made the balance sheet stronger by getting rid of the business that was the least profitable and most cyclical. The company had good results in the second quarter, and we think it is in a good position to handle any short-term uncertainty. We think that the stock is worth about $75. Please leave a comment below if you have any further queries, and our team will try its best to answer them as soon as possible.